The mid-cap index is having a better showing, so the broader markets are looking pretty good.
What is started in 80s, from 15-16% 10-year to zero, I think that one phase in pendulum is done.
Broader markets continue to do really well, so 4% higher on the mid-cap index.
Day on the downside a little bit though, 50 points down on the Nifty is what we have.
It's a very range-bound day. By the way, today the range on the Nifty, between the low and the high, it's not even been a full 100 points. It's been that close of a choppy market, but in an extremely narrow band.
You're watching us here on Markets Today. This is a show where we talk about all the 5 headlines that made today's trading session. I'm Manglam Malu. It was a rather range trade in today's trading session. It was also a Thursday, so it was the weekly options expiry of the Nifty. Let's talk about those 5 headlines itself. The first one is Sensex and the Nifty end with marginal losses after a range-bound session. SIP contributions since the start of this financial year surpasses 1 lakh crore rupees. We got the mutual fund data as well. Apollo Hospitals was the other stock which was in focus in today's trading session on account of the good second quarter performance, and as a result of which that stock ended 4% higher.
It seems like it's business in Cipla. I don't think we're not part, doesn't seem like we're part of any transaction.
Cipla CEO Umang Vohra says that it does not seem like Cipla is a part of any transaction. Also maintains that news surrounding a potential stake sale is speculative. Says Cipla chairman Yusuf Hamid does not care about ownership and wants the ethos to continue. That's an exclusive. A bunch of other stocks in focus. Tata Power skids on profit taking despite a good show. Ramco Cements gains on an overall beat in the second quarter. ABB rallies as margins expand at 16% in the third quarter. Ashok Leyland reports a mixed bag and net profit as well as revenues come in below estimates, but margins are a beat. Market veterans Ramdev Agarwal and Manish Shokhani spot risks in the US interest rates, fiscal deficit and the currency market, but see these driving money to India where they eye investment opportunities in financials, EVs, real estate and green energy. Let's tell you what's lined up on the show today. We have Gautam Trivedi in Market Opinion. He is obviously the founder of Nepean Capital. Big corporate voices, and we have a lot of them. Umang Vohra, the MD and Global CEO of Cipla, among other voices. Let's start with the market headline then. We have Sensex and the Nifty, which ended with marginal losses after a range-bound session. Midcaps managed to buck the trend, ending with some gains. The Nifty Bank Index also did outperform, undoing its yesterday's underperformance. By and large, it was a range trade also because there were a lot of options written around that 19,450 mark in a day where we had the Nifty weekly options expiry. Prashant joins in with more details.
Well, it was a dull kind of a session, sideways for the most part. There was no really bounce at any one point. And we ended not at the day's lowest point, but pretty close to it. So lackluster. So 40-point cut on the Nifty approximately. The Nifty Bank doing a little better, and that's been the weaker of the two indices. Mid-caps and small-caps really not very much there as well. We were talking about in the morning how yesterday, for example, the small-cap index closed at a new high, but it was not accompanied by volume expansion in the broader markets. And that's not exactly a great thing. So something which we need to track. Now, losses on the Nifty index coming through in names like Adani Enterprises, HUL and Adani Ports. Gainers in the form of Mahindra & Mahindra, Apollo Hospitals and Coal India, which stood out. Broader markets, declines outnumbered advances. I mean, that flipped mid-afternoon and never recovered. Not a big margin in terms of gap or anything, but MTAR Tech, large cut. These exchanges, both MCX and BSE came up and lost on pretty large volumes actually. Pullbacks because they've done so well. Bajaj Hindustan, Mama Earth, which is Honasa, is I think just under 300 rupees now. Mishra Dhatu, Precall, Amber Enterprises, SKF India, Endurance, Atul Auto were some of the others which actually saw these pullbacks. Gains as well, I mean, in names like PFC, CDSL continues to do well. Welspun Corp has been such a, I mean, it's basically doubled this year. Sobha Developers, Jayaprakash Associates is back above 18. Metropolis, Uno Minda, Newland Laboratories, or a few others. We'll wait for signals from the US markets, of course. As always, the important thing, of course, there is what happens to yields and oil. Both have plunged non-stop over the last 10 or 12 sessions or so. Is there more there, and what does it indicate? Does it indicate a bit of a broader risk-off, or should that be read into to mean that it's good for risky assets like equities? That's the moot point here. Back to you.
All right, Prashant, thanks a lot for that. With that, let's get you some market opinion. As promised, Gautam Trivedi of Nepean Capital says that India is actually the most expensive market in the world in terms of valuations, and as that domestic investors do have a lot of faith. So let's hear them out.
I think the interest in India clearly is at an all-time high. I've never seen this before, and clearly at the expense of China. So that's the good news. Having said that, I think there's a bit of a wait and watch with respect to incrementally putting new money to work in India. And that's coming from the fact that we are still the most expensive market in the world. So there's no, running away from that, unfortunately. And I think even though we've seen over $5 billion of selling by foreign portfolio investors in the past just over 2 months, in spite of that, I think a lot of that has been offset by domestic flows. So until the domestic flows don't slow down, I don't see a deep correction in this market. And that seems to be, I think, a bigger problem with respect to putting incrementally more money to work.
All right, incrementally more money. 16,928 crores is what came through in the SIP route in the month of October itself. Second straight month of $2 billion coming in our markets via that route. But let's talk about the second headline. Apollo Hospital rallied over 3% after margins expanded to 13% in the second quarter. The company reported a beat in the revenue as well, closer to 5,000 crores in terms of a top line. The net profit missed street expectations, but Ekta Batra joins in with the fine print. Ekta.
Well, yes, for Apollo Hospitals this quarter, the numbers were better than expectations. The revenue growth was around 14% versus estimates of around 12% growth. The margins just about expanded to around 13%, 12.9% to be precise, versus estimates of around 12.6%. And the profit was at around 248 odd crores, which was a growth of around 17% on a year-on-year basis. Now, one of the key points is that all of the segments that they have, the healthcare, digital, the healthcare segment, which is hospitals, digital, as well as diagnostics and retail, all showed double-digit growth this quarter. So, for example, the healthcare segment, which is hospitals, was up around 13% on a year-on-year basis. The margins were maintained on that one as well at around 20% year-on-year. And we had the digital health and e-pharmacy segment, which was up 17% year-on-year in terms of revenue. And the EBIT loss narrowed to around 51 crores versus 54 crores on a year-on-year basis and on a Q-on-Q basis. Now, in terms of the diagnostics and retail segment, the revenue was up around 11% and the EBIT came in at around 3 odd crores versus a loss of around 10.3 crores in the previous quarter. So overall, double-digit growth in all three of their segments, plus margins maintained for segments such as the hospital business at 20%. So good going for Apollo Hospitals.
Good going indeed. Let's talk about the third headline. Ekta, thank you for that. This one comes in from the pharmaceutical space as well. Cipla CEO Umang Vohra has said that it does not seem like the company is in part of any transaction. Speaking to CNBC-TV18's Ekta Batra, he's also maintained that news surrounding a potential stake sale is speculative. Added that the chairman, Yusuf Hamid, does not care about ownership, but wants the ethos of the company to continue. He also cited Tata Sons and Asian Paints as examples of promoters and professional management coexisting through generations.
There's been so much speculation about whether or not Cipla is on the block, whether the deal will go through. What can we expect? I know you're a part of the company and not a part of the promoter entity, but can you clear the air for us?
Yeah, I'd love to. Whatever we do is public. The company's maintained that this is a speculative sort of information that's around in the marketplace. The company doesn't comment on it. The promoters have not commented on it. We respond to what we do as a company through various statutory, announcements, etc. There has been none, right? As of 2 days back, we also opened the window for our employees. So I think people could infer, right, that things are, based on all of this, that, it seems like it's business in Cipla. I don't think we're not part, doesn't seem like we're part of any transaction, otherwise we wouldn't have opened the window.
Okay, but what about the future of Cipla? Because Dr. Hamid obviously must be thinking about what he wants to do next.
Yes.
And where he wants to leave Cipla. What do you think is probably the most feasible option for him, or what he's most comfortable with? A PE, a promoter entity, or maybe the second generation running it?
You know, I think it's difficult for me to, try to unravel the depths of Dr. Hamid's experience, mind, thinking at this point in time. I can only tell you what I pick up, right, from him. I think he's most concerned about Cipla, right? And it doesn't matter to him, at least the way I've understood, about ownership. He just wants the ethos of Cipla to continue. And to a certain extent, he's relying tremendously on the management team to continue to do that. And, he's pointed out several examples to me of how companies such as the Tata Sons, how companies such as Asian Paints, these continue to coexist through generations of promoters and generations of management, right? And so in a sense, it's not Dr. Hamid's problem anymore. The way it's been told to me, it's become my problem now to ensure that the company continues to survive, continues to live, has succession of people in the management side. And as much as he plans for succession on the ownership side, I have to plan for succession on the management side. So it's a dual problem, and I think we're rested with it. And
all right, the other pharmaceutical stock in focus was Lupin. It met street expectations across most parameters, majorly led by the US business. The MD Nilesh Gupta said that there is a lot of room for Lupin to grow. They actually aim to grow 30% ahead of the industry. Let's hear him out.
In the last 10 years, the market grew over 10%. We grew over 13%. And we've talked about a clear goal of growing at 30% ahead of the market. We're doing that in all the therapy areas, but for diabetes. The growth was 6.9% for Q2, but if we adjust for NLEM, it was 8.9%. And diabetes, which was degrowing in the past, as per IQVIA, we still look like we're degrowing, but we're actually growing a few percentage points now. Everything else was on a strong double-digit growth. India went through this period of challenges on exclusivities and the like, but that's largely behind us. We're back to 30% ahead of market growth. So that has to continue. But we're very optimistic. I think there's a lot of great energy within the company and lots of opportunities that we see across the world.
All right. That's the word coming in from Lupin. We'll take a short break, come back with all the other headlines, some from other sectors. Welcome back. We spoke about the markets today. We also spoke about a bunch of stocks, pharmaceutical stocks in particular. There was Apollo Hospitals, Lupin and Cipla as well. But let's talk about some other stocks that made the news today as well. Ramco Cements. The second quarter results of the company beat street expectations on all parameters. The revenue saw a 30% jump year on year, over 2,300 crore rupees. Profits almost grew 10 times as compared to the same quarter last year. And that's also on account of a favorable base. And margins increased from 10% to 17%. The stock ended higher with a gain of about 1.5%. Nigel joins in with the key numbers. Nigel.
Ramco Cements, that one came out with a set of numbers, and in fact, it looked quite good. There's a big beat on the top line itself, close to around 250 crores beat on the top line. Why was that? Because volumes were much better. Now, we were working with volumes of close to around 4 million tons odd. The volume number has come in around 4.6 million tons odd. So that's one of the key reasons for the beat. And the beat on the top line has further percolated down into an EBITDA as well as the margin beat. The profit number as well looked quite good. Now, the key reasons for the beat one was in terms of volumes. Volumes look very, very good. The second factor is the power and fuel cost. It's down sharply both on a year-on-year as well as on a sequential basis. Remember, they've changed their mix a little bit. They're using one of their captive units as well internally. So that's helped them out there. And the blended fuel cost has come down drastically on a year-on-year basis. In fact, on a year-on-year basis, the effective cost per ton is down by nearly around $50 per ton. So that's clearly played out there. The profit number, well, yes, that's up sharply on a year-on-year basis. That's because the other income did support. But you need to note that the net debt number is close to around 5,000 crores odd because of the expansions that have come on stream. And that explains why the finance cost as well has ballooned out. Short point, though, that these numbers look good. The key reason for the beat on Ramco Cements is because of their volumes, better than expected volumes. And the second factor is the power and fuel costs, which have played out much lower on a year-on-year and a sequential basis.
All right, Nigel, thanks a lot for that. The other stock that surged after reporting a good set of numbers in today's trading session was ABB, where the revenue came in at over 2,700 crore rupees versus an estimate of over 2,500 crore rupees. The net profit also beat street expectations, coming in at a little over 350 crore rupees. Margins grew to over 15% from 10% in the same quarter last year. Upasana Bhatt joins in with the numbers. Upasana.
Well, it was clearly a margin beat, and margins expanded by almost 519 basis points at 15.8% versus the estimate of 12.3% that we were working with. In terms of revenue growth, it stood strong at almost 31% on YoY basis, and it was mainly led by two segments, that is robotics and discrete automation, which saw an uptick of almost 107% on YoY basis, followed by process automation, which saw an uptick of almost 93% on YoY basis. Now moving towards the PAT growth was also strong. That was almost about 84% on YoY basis, which was mainly led by rise in other income. Now moving towards the company's margin, as mentioned earlier, it stood at 15.8% versus 9.9% on YoY basis. So all in all, revenues stood above our estimate. PAT also stood above our estimate, and EBITDA margins were a beat above our estimate of 12.3%. Now moving towards the total order, it stood at 3,004 crores for the quarter, and order backlog stood at 8,008 crores for the quarter. So all in all, we are seeing a strong set of numbers coming in from ABB India.
All right, strong set of numbers coming in from ABB India. We'll obviously listen into what brokerages have to say about that. The stock usually tends to have a big move the next day of trade as well. Staying with the earnings itself, Ashok Leyland slipped almost about 2% after missing street expectations on the net profit and revenue front. Net profit came in at around 561 crores. That was below expectations. The street was working with a number over 600 crores. The automaker reported a revenue of around 9,600 crores. The street again was expecting revenues closer to 10,000 crores, 9,800 crores, in terms of the top line on an approximate basis. So that was the stock which was on our radar. With that, let's move on to the fifth headline of the day. Market veterans Ramdev Agarwal and Manish Chokhani are seeing risks in the US interest rates, fiscal deficit and the currency market. However, they also see these driving money to India. They eye key investment opportunities in financials, EVs, real estate and green energy.
Interest rate cycle has peaked out. I think it's a too big a statement to say. I mean, yes, there looks to be some kind of a pause right now. But to say that it has been picked up, I have no view on this interest rate cycle. But one thing is for sure that what we have seen last 10, 15 years of sub-zero or zero kind of a thing where 12, 15, 13 trillion dollars of bonds, particularly in Europe, went below zero. So that era is over. You know, what started in 80s from 15, 16% 10-year to zero, I think that one phase in pendulum is done. And now, as Howard Marks says, you know, pendulum moves all the way up. So from zero, we have come to 5.5%. Whatever happens, I don't know, but it is definitely not going to go back to zero immediately.
If we don't get 100 billion a year, I would be very, very surprised.
Okay.
And I do think in this decade, we will be the bubble market of the world.
100 billion per year?
Per year.
FI?
No,
FDI.
I said FII plus debt plus FDI. Cumulative inflow. So your balance of payment problems and the rupee depreciation is gone.
Okay.
You are the momentum market going forward in this decade. The way the world flipped on Japan with one trade of Buffett. Because everyone's acting like lemming. There is a single trade, single dimensional investing going on. I think we are setting ourselves up for that.
Okay.
It's still a way. I mean, let's get the May election out of the way and then we see.
All right, and finally, the Burman family, which runs the FMCG company Dabur, has responded to CNBC-TV18, refuting all allegations made by the independent directors of Religare Enterprises. According to an Economic Times report, 5 independent directors of Religare had accused the Burman family of wrongdoing and the frauds as the family looks to acquire their company. Vivek Iyer joins in with more on the allegations, but more importantly, the Burman family response here. Vivek.
Well, ever since the Berman family had given an open offer to the shareholders of Religare Enterprises, there have been multiple allegations that have been leveled against the Berman family, and this is now being done by the independent directors of Religare Enterprises. Now, what the ET reports is that the independent directors have written to the regulators, that is the RBI, the SEBI, as well as the insurance watchdog, that is IRDAI, alleging various wrongdoings on part of the Berman family. In fact, out of the 6-member board, ET reports that 5 of them are independent, and the board is led by Executive Chairperson Rashmi Saluja. We reached out to both, the Berman family as well as Religare Enterprises. The Berman family has given a point-by-point rebuttal to all of the allegations leveled against it by the Religare Enterprises independent directors. The first allegation is that, Bermans are in material breach of regulatory obligations that may harm the firm. They respond saying that, the Berman family has purchased all of the shareholdings in Religare Enterprises through transparent market purchases and preferential allotment in prior fundraising exercises that was approved by the board of Religare Enterprises. There is no market manipulation whatsoever. Secondly, the independent directors state that parties seeking to acquire the business ought to be scrutinized for the fit and proper criteria. They respond saying that, the Berman family and its members satisfy all norms of fit and proper criteria mandated by financial services regulators, and this allegation is baseless and devoid of any merit. The third allegation is that, the allegation includes charges of collusion with earlier owners, that is the Singh brothers, and also against Dabur India chairman Mohit Berman. They respond saying that, these allegations are false, frivolous, and defamatory in nature. Along with that, they say that the charges that plague Religare Enterprises. Also, there have been questions be used for the acquisition. There's a strong rebuttal coming in as far as this particular point is concerned. The Berman family says that, they run a significantly large sufficient assets far in excess of the proposed acquisition. The reference to our activities being fraudulent and illegal is baseless as well as defamatory. Now remember, Religare Enterprises has 4 key businesses. To acquire this particular business, there could be an RBI approval that insurance provider. To acquire this particular business, there could be a requirement to get an approval from IRDAI, Religare Housing Development, and Religare Broking, 2 are the other businesses that are being held. It's a very interesting story. Remember, we've reached out to Religare Enterprises as well, and so far we are yet to receive a response from them.
Vivek, thanks a lot for that. With that, we wrap up on this edition of Markets Today. Thank you for watching. Stay tuned to CNBC TV18 for more news and updates.